All right, John, welcome to Living Off Rentals.
Thank you. Thanks for having me. Good.
Yeah.
Happy Friday to you.
Happy Friday. Yeah. It's great to have you here. For those who are tuning in who aren't familiar with John and his background, John's a multifamily expert, and he's managed or assisted clients with over 60,000 units in 40 states. So a big breadth of experience in the multifamily space. He's also authored a couple of books. So How to Read a Rent Roll is one of them. And then Multifamily Insights, Volume 1 and 2, Buying the Right Multifamily Asset in the Right Markets. So that's exactly what I want to get into today is, what those right multifamily assets are and what the right markets are. So
Okay.
I want to dive into that. But first, I'd love to hear how you got started with multifamily investing. I think a lot of our listeners are single family investors and they feel like they want to get into multifamily, but it's kind of complex and they don't know how to get into it. So how'd you get started with it?
I got started because I was dragged into it at a young age by my dad, who was a longtime City of Los Angeles employee and bought houses and small multifamily on the side. Way back in the day when nothing down deals was all the rage, you could buy nothing down deals in the 70s if you worked at it. It's not nearly as prevalent today, or I certainly wouldn't recommend it today. But I was an only child, so I'm the only son. Wherever my dad goes on weekends, I'm going. So whatever he's doing, I'm doing, and I'm not liking any of it because I'm painting, I'm picking up trash, and I'm just thinking there's got to be a better way. So I'm going to college. And with that, yes, maybe I'll be somewhere around this real estate stuff, but I'm pretty decent with numbers. And I think if I do this right, I don't have to do the actual physical on the ground work, but that doesn't mean I can't be in the business. So in college, I started flipping homes. And at that time, homes were $50,000 to $100,000. I could make $10,000 as a 20-year-old, and I thought I was just the ish. I thought that was great. But so I dropped out of college and started doing that more. But then markets change, right? So I didn't know markets changed. I'm 20 years old. I'm 21. I'm 22. So after buying the cars, and the houses and losing them all, I said, maybe I should go back to that college thing. So I went back to college and finished at Pepperdine and then started working in multifamily asset management, which was exactly where I was probably, 7 or 8 years earlier, right? Hey, this real estate thing's pretty good, but I don't really want to be the one that's responsible for putting in a door. That's not what I do because I'm, Butterfingers. I'm better working with numbers and with people and with processes. And it just kind of snowballed from there.
I see. Okay. So can you take me through your journey of multifamily then? So when you transition into multifamily, what did you start buying?
When I started buying multifamily, my first multifamily is anything more than 5 units. So we'll start with that. So if it's under 5 units, it's not considered by the world, including Fannie Mae, a multifamily property. So if you want to become a homeowner and a multifamily owner, buy a duplex, triplex, or fourplex, because you can do that as a quote unquote homeowner with a low down payment and get into multifamily and also be a homeowner, right? So I'll get back to your question in just a second. But that said, that's the best way to get into multifamily with a low down payment, not having to have 25%. But my cue to you, those of you that want to do that, is make sure to bring property management with you. So even if you only have a duplex, even if you only have a triplex, don't pretend like you have to be the one that manages, because that is a whole nother field of expertise. And not to say that you can't learn it, not to say that you can't excel at it, but if you're just starting out, bring that expertise with you so that you have those other folks that have been in the business and have standing and know what to do, and learn from them along the way, and then see if you want to do that also. So back to my multifamily journey, I didn't start really buying multifamily until I was in my 30s. And I did it at the wrong time, in the wrong place, and I did it completely wrong. And I had a high level of expertise. What I didn't know is that apparently I didn't learn that lesson from my 20s, is markets change. So I bought 200 units. I bought them between 2004 and 2007.
Mm.
And that was the absolute worst time in our lifetime to have got into multifamily, unless you have significant capital or equity, because of everything that happened between 2008 and 2011. So I worked through that process. I didn't lose any assets, but with those 200 units, I can tell you that I made more money as a providing expert advice for large portfolios than I did as an owner. And for me, I really wanted to be an owner. I really wanted to do that lifestyle, but I didn't have the significant equity necessary. I knew bringing in partners was a whole nother different type of strategy and perspective. I didn't want to do that. So I exited the business. And with that came even more knowledge about what not to do and how not to do it. And I may still well go back in, but if I go back in now, I won't buy anything less than 100 units, because those are the economies of scale that actually work. Yes. That was my wife saying, "Are you still on a podcast?"
Nice. Does she
yes,
want to
dear,
join?
we're still on a podcast. Yeah, no, I think she's got her own training going on right now.
Nice.
So I'm not saying I won't go back into the business as an owner, but I did pick the absolute worst time. I didn't go bankrupt. I didn't sell any properties. I mean, I sold properties at a loss, but I didn't sell. They were not. What's the word? I didn't lose them. I had to give them away, and with that came certainly a lot of pain.
Mm-hmm.
And but I learned through the process.
Yeah.
Don't want to do it again the way that I did it in 2005 to 2008. I was doing exactly what I wanted to do. I was right about 10 million in assets, ready to go to 20 million in assets, had everything aligned. And then Lehman Brothers made a phone call and the world changed. And who knew? I mean,
right.
It's just, and then really the kicker for me, the reason that I didn't retain ownership through all of that is because we had zero rent growth for years.
Mm-hmm.
And we had never in my lifetime experienced zero rent growth for years. Mm-hmm. So no matter who you are or what you're doing, expenses rise, right? They don't wait on anybody. They don't not happen because of you. So expenses continue to rise incrementally. I'm not suggesting old words, but zero rent growth. So I couldn't grow my way out of the problem. I couldn't do those things I knew how to do in normal times. So working with larger portfolios, working with large owners, they can write a check to get themselves out of an issue. Yeah, I could write a check, but I couldn't write a $250,000 check at will.
Yeah.
It was really a struggle for me to do the things I knew that I should do. But again, for me, that would have meant bringing in partners, which is a whole nother, you basically lose control of your portfolio when you do that. And I was better off jettisoning the portfolio, working for those large owners, merchant builders, people that had really large portfolios that were in trouble, but also had more options than I had as a small owner. To me, having a few hundred units was a small owner. Mm-hmm. And I wish I still was in that space, but I wouldn't be where I am now. So we learn from that, right? We learn from that. And I've made a lot more money doing what I do than I was doing as I was an owner at that time in history in the early 2000s.
Yeah. And what's your role now, or what was your role after you stopped being an owner of assets? You became a manager and an advisor. How does that work? Because I don't think people understand all the different roles in this industry.
Yeah. It's just like saying you're an attorney. Well, what do? Do you do environmental law, marital law, or are you working on nuclear plants? So just being an attorney doesn't mean you're working on just family law. Mm-hmm. What I do in real estate is a very specialized expertise. It's called real estate asset management. So asset managers, in essence, they represent the owner in all matters. So I represent the owner presently, my largest client, of a 2,000 unit portfolio, which generates around $20 million a year. And my role as the owner's representative is to act as if I'm the owner or on the owner's behalf. So I make decisions with respect to who manages. I make decisions with respect to property insurance, dispositions, acquisitions, redevelopments, all of those matters that any portfolio of size is going to have on an ongoing basis. Somebody has to make those decisions. And the owner doesn't necessarily want that responsibility because they have other businesses. This is just one of their businesses. So for larger owners, those that have 4,000 units and higher, they'll generally hire a Prudential or a Berkadia. But those types of managers, they really only manage the financial piece of the asset. Whereas a real estate asset manager who's fully engaged, such as I am, we in essence manage the entire evolution and process for the asset. And our primary goal, preservation of the asset, preservation of capital. So that's what we do.
Got it. Okay. Yeah. So I think, listening to your story, there's so many of those stories from 2008, that, like you said, nobody can predict the market. Now, right. I think we're sitting in this place where there's a lot of self-proclaimed multifamily geniuses out there because, the market right. for the last decade has been in their favor. So it's like, you can't lose. You got the golden touch, right?
Are you sure we're not related? Because I use that word all the time. I said, the gentleman that owns 2 homes in Orange County, California is a genius.
Yes.
Because he has a house and he bought 1 rental. Because in Orange County and Irvine, that house is $1 million house.
Right. Right. Yeah, so if he bought it 10 years ago, he bought it for 200 grand. Yeah.
Right. So. And I'm happy for him, but I don't necessarily apply the word genius to that. Yeah.
Yeah. Yeah. So it brings up an interesting question then. So I for about a year, I thought I was going to transition fully into multifamily homes. And I bought 1 apartment building, and my big challenge was that when I buy single family homes, I can stick up a bandit sign and I can find a property that a hoarder lives in, and they call me and say, I need to get rid of this thing, or somebody inherits it from across the country and they need to get rid of it. Typically in multifamily, those types of deals don't exist, or at least they're very difficult to come across. Mostly it's investors who list the property, and then whoever's willing to pay the highest dollar is going to get that property. And so the property analysis is based on today's numbers, right? It's based on, everyone's doing has the same information, and they're calculating, and it's how much risk you're willing to take. And so as interest rates have gone down over the last decade, and the market conditions have been in your favor, it's made people really wealthy, and their assets have looked really good. But what I struggle with is trying to get into multifamily, and what I struggled with for about a year when I was trying to get into this is, what if interest rates go from 4% now to 8%? All these properties that have, say a 5 to 10 year balloon. And then when it balloons, it's at 8%. How does that work? Cause I was always like trying to figure out, where do we go from here? Cause it seems like we're kind of at the best market you could possibly be in. So like, how does that work?
From an interest rate perspective, yes. Yeah. So let's talk about small scale, right? Because that's where most people are. So buying and selling single family homes is a great business. Buying and keeping single family homes is a better business because you're building equity over time, right? So versus just the buy sell trade, where you're basically, you put yourself into a job. So every time you make $1, that was good, but now you have to go do it all over again. So buying and keeping single family is a great business. Multifamily is a better business because you have fewer windows and doors. That's the reason why, because the economies of scale that come into play with multifamily, your maintenance costs over time are less. The uniformity of the asset is better. And there's just, so before I go down that path a little bit, back to why multifamily is better. Even as a fourplex, if you're buying stock, you have the same windows and doors for all 4 units, right? If you have 4 different houses, you have 4 different roof lines, you have 4 different yards, you have 4 different fences, you have 4 different lot lines. So that's that much more to maintain. So it's not a bad business to get into the real estate game, but buy and hold is better than buy and flip, because you've got to do it all over again and again and again forever. So even if you only buy 2 homes in a year, I'm saying that's for the active investors. Keep one, sell the other one. Sure, get your equity back so you have equity to do additional deals. But if you buy 2 the next year, keep one. At the end of 10 years, you have 10 homes. And that's a portfolio, particularly if we do have rent growth, which we normally do. Over 10 years, you will have built some significant equity there. But if you buy a duplex, going back to that initial acquisition, and you live in one and rent the other, bring property management to rent the other one, to take care of the other one, and then you can look for your next deal. But you didn't have to put any money into the first deal because you're a homeowner, right? You're a homeowner. And the duplexes are all over the country. They even come with 2-car garages. Some of them have 4 bedrooms and 3 baths. So we're not talking about just junky 1950s brick flat roof duplexes that are workforce housing built off the Air Force Base, right? They're far more sophisticated, even maybe with the jacuzzi in the back on the back slab. So don't think duplexes are just something that's a starter and a starter only. It really can be a lifestyle. It really can be a home for you and your family and a place to start. And I'm not suggesting don't buy a single family, but I'm saying if you want to get into the rental business, that's a way to do that. But going from there to multifamily, the reason to do it is you have fewer windows and doors. There's uniformity in your stock, and there's only one asset to deal with at one time. 4 in one place versus 4 in 4 different places. And you have 4 different places where you can raise rents. You won't have one, when you have one vacancy, you're not at zero income. If you have one vacancy, you're still at 75% income. And you can maneuver through that while you turn that one unit to get it back online or to get it rented again. So on a small scale, those are the advantages to small multifamily.
Got it. Okay. So from a analysis perspective, though, just to kind of compare the two. So, if I buy a hoarder house, which is like the ideal house for me, I'm going to buy a house that it costs me. I know it's basically all labor to clean out that house, but you get a huge discount because it's full of garbage and cockroaches and whatever. So as soon as I'm done with that rehab, I've created a ton of equity in that property, and then there's cash flow on it. But those types, like I was saying, those don't exist. Usually it's there's ways to improve the cash flow on it, but what I struggled with is not having that equity from day one in the property, and so it's kind of based on the market conditions, and so I'm trying to wrap my head around if the market were to turn from a multifamily perspective, is everyone just kind of screwed? If the interest rates doubled, does everyone have to just give the keys back to the bank because they can't refinance, or how does that work?
Well, there's always going to be interest rate exposure with multifamily because you're not going to get, or seldom will you get, a 30-year fixed rate mortgage, right?
Right.
However, USDA does that. Rural development does that. If you're in a urban environment, you can get a long-term fixed rate loan from a government or a GSA, government source. But that said, everyone does have interest rate exposure, not going to change. If you have a 30-year mortgage with a 10-year fixed rate or 5-year fixed rate, that's the exposure you do have. But generally speaking, remember that we're talking about time value of money, right? And ownership over time. If you're in the buy and flip business, you're always going to be looking for your next deal. If you're in the buy and hold business, you're not buying everything on the same day and trying to sell it on the same day. You're not getting a loan for everything in 2021 and selling everything in 2018. It's a evolution over time. So you will have interest rate exposure on any one of your deals. Let's say you have four fourplexes, and that's your entire portfolio. Well, when interest rates hit 12% in 6 years or whenever that happens, right? Sure. You may have to deal with that one asset, and because you're out from under your fixed rate at that point. But it's not all going to happen to you all at the same time, very likely, if you're in small multifamily. Now, in larger deals, then that arbitrage or that risk exposure is greater, but there's also greater equity and the ability to refinance. So, for instance, what do mall operators do today? I have no idea. Right? I just don't know I wouldn't know what to do with a mall operator. But let's say that today multifamily was exactly in the same place as malls, meaning significant vacancy, no access to equity. You're basically going to end up shrinking your portfolio. You're going to sell what you can and put that equity into the remaining deals so that you can get reasonable reasonable loans on those. So if there's any two things that we would bring out of this conversation that I want you to take forward forever and a day, one would be to get fixed rate mortgages if you can, right? And always get fixed rate mortgages. I know that's hard, but you can get 5 and 10-year fixed rate mortgages with multifamily. And to not be complacent, meaning don't just assume it runs itself. No real estate asset runs itself. Every real estate asset needs management. So hire, find professional property management and give yourself that advantage. Yes, there's a cost to that, but you fold that cost into your operations and it allows you to live your life as a regular and normal person. You're not on call 24 hours a day. If there is a fire, there's someone for that resident or that neighbor to call to say, hey, there's a fire. And then when they call you, the owner, you're going to say to your manager, I understand there was a fire, but someone called the fire department. But likely no one called you at 2:30 in the morning to say, hey, there's a fire. They called the manager. After calling the fire department, the manager went to the property to address the issue, hoping there's no bodily harm, hoping there's not much damage. But, 50% of the time it's a kitchen fire, right? Something happened in the kitchen. And fortunately, most of the time it doesn't go to other units. And the people in that one unit said fire and they got out. But you as the owner find out about it the next morning and you say, okay, well, good, let's do a claim, and life goes on. You don't have to upset your entire lifestyle because you have a 40-unit building or 4 40-unit buildings.
Yeah. That's an interesting concept that you mentioned there that I hadn't considered. Is it's almost like dollar cost averaging your assets over time. Right. I was kind of thinking from the perspective getting into it is like just about the first one that I'm buying. But if you're continuing to buy one every year over a 10-year period, then all these different loans come due at different times, and you can dollar cost average it all together.
Well, it's a form of a risk arbitrage, interest rate arbitrage. And let's say that the average guy, woman, family, they buy one property every other year. Okay, so if you end up refinancing all of your properties all in the same year, then you're really increasing your risk. Versus, you buy one, 3 years later, you buy another one, 3 years later, you buy another one, at which point you've probably refinanced your first deal to take some equity out to buy the third one. So then you have a fixed rate mortgage all over again, right? And now you're transferring that risk to the property you just purchased, which may or may not have fixed rate, which may have more leverage. But controlling leverage, bringing property management with you, not being complacent, you're going to be in a good place. Yeah, that makes a lot of sense. I know you're big on analysis of properties, and I think that's what trips up a lot of people. Like, where do I start? So, what are a couple of the biggest due diligence things that you would recommend people focus on, or maybe some of the big mistakes that you've seen people make that they overlooked that maybe isn't quite as obvious? Not as obvious would be arrogance, I think. Before we get into the numbers of it, I know more than anybody else about my market. No, you don't. You may know a lot about your market, but you don't know more than anybody else. I'm not segregating markets, meaning not utilizing sub-market analysis. And I use Dallas as an example always because it's so easy. It's a big city. A lot of people have been there. Dallas has 38 submarkets. 6 or 8 of them are really good. And then the rest, there's a downhill slide from there, right? So if you're going into any market, even one that segregate it into submarkets, because that's where properties compete. They don't compete in Michigan City, the entire city. They compete in east, west, north, and south, or southeast and northwest. People that live in an area, and let's just pick Indianapolis for an example. People that grew up in North Indianapolis, the likelihood that they're going to move to South Indianapolis, which is how many, is that 20 miles?
Probably
not very likely. Yeah, not very likely. Even if they're a homeowner, they're not going to uproot their lives in northern Indianapolis and move south, because this is where, they know the commute to work. They know where the hospital is. Their kids are in these schools. They may move. They may move 5 miles or 8 miles. But, in this country, most people live and die within 50 miles of where they were born. Not everybody, of course, but most people do. So we're very localized, right? All politics is local, real estate is local, but yet within that local environment, the submarket is the key. Understanding where your property is and where it competes within that submarket. So there's comparative assets, right? Those that look like yours, but there's also competitive assets. And the competitive assets lie within the same submarket of where that property is. Did I answer the question, or did I go off the rails again?
No, that's really interesting. So from a due diligence perspective, you think the location and understanding the submarket is one of the most important aspects.
That's where 50% of your yield comes from. Yes. Yeah,
okay.
On practically 50%. So if you understand the submarket, and the other thing that where people go sailing down the river, wondering if they're going to get to the riverbanks ever again, is when they're in acquisition mode and they say, okay, I've got the money, I've got the expertise, I have my team around me, I've got legal, I've got a real estate broker and somebody else looking for me. And then they flip the switch, right, and say, okay, I'm ready to buy. But yet they haven't predetermined where they're interested in buying. So if they're in Dallas, they're going to get deals from all over Dallas, as opposed to saying, you know what, I've already decided before I flip that switch, hey guys, here's the 3 submarkets I'm interested in. Anything that comes up in those 3 submarkets, I really would like to see it. If it's not in those 3 submarkets, please don't disturb my morning coffee because I'm not going to go. And that in and of itself really puts you on a tight leash because you've already done the work in advance, right? So now let's get to the analysis part a little bit. So analysis is what my book, How to Read a Rent Roll, is based on. Because if you understand rent roll analysis, you understand property from a financial perspective. So I wrote a book behind How to Read a Rent Roll, How to Read a Rent Roll, which is called Rent Roll Triangle. And that basically dissects the income for a multifamily property or a rental property in this case. Because there's 3 types of income that everybody knows about, but they don't put them in the same calculation. And that's what I did with Rent Roll Triangle. So there's gross potential rents. That's the rent that everybody wants to get, right? Then there's what's in the lease, the actual stated lease that you as the owner signed, the resident signed. That's the lease amount. And then there's the actual collections, which is not always the same. It can be, it often is in a single family. But in multifamily, there's different levels of collections, right? If you have 10 units, everybody isn't paying their $1,000 a month on the first of the month every day. Right, every first of the month. So you need to know what that number is. What did we actually collect versus what our rents are, what our leases say. So I took those 3 calculations, and then I added a 4th external factor, which was the term of the lease. And the real deal is the longer people stay in place, the more money you make. If you're raising rents just for the purposes of getting higher rents, but you're creating more turnover, you're actually reducing the value of your property. So you have to have that balance between rental increases, trying to keep people in place. So you're not creating turnover, right? So you're not creating work for yourself. You're also not creating vacancy. There's a reason to create strategic vacancy, but that's a whole nother podcast. But the 3 types of income are what are in Rent Roll Triangle. And you can find that calculation on my website soon. I have an author's website, which is johnwilhoit.com. And I'm working on 2 financial calculators, which everybody will be able to use, but they're not quite there yet. One is a financial analysis that will allow you to come out with 18 different points of specific financial data on a property. And the other one is Rent Roll Triangle, which gives you a score. So if your property is scoring in the 70s or 80s, and you don't know why, you can look at the 3 types of income and see where the gaps are. And those gaps tell you where to concentrate your attention. So if you've owned that duplex for 15 years and the same people have been there, remember I just said you don't want to create turnover. Well, wait a minute. This is a different circumstance, right? You haven't raised rents. They've been there forever. They're paying $1,100 a month and the rest of the market is at $1,750. Hey, you know where the gap is. You should be at $1,750 and you're only getting $1,100. So you know where the gap is versus you're at market rents, but 2 out of 10 tenants or 2 out of 10 paying customers are not paying. Well, guess what? You know that you need to do some evictions and get that taken care of. So it's no longer a guess if you're using Rent Roll Triangle, is where you need to focus your time to increase your income.
Got it. Yeah, that makes a lot of sense. So speaking to your first point, 50% of the analysis or value of the property comes from the submarket and location.
Yes.
I know you wrote 2 volumes of the book, buying the right asset in the right markets. So are there specific markets right now that you feel are the place to be investing, and have the long-term positive outlook? And then are there certain ones that you feel like you would never buy in no matter what?
It's a matter of scale. People that live in a local market and they live in Little Rock, they're just flat out not going to Memphis, right?
Mm-hmm.
So if I were to say, Memphis is a hot market and never invest in Little Rock, that doesn't make sense to them, because that's where they live their life. That's where they want to make their investments, because small investors, they want to kick the tires. But I'm in California a lot, and California investors, they already know, small investors, I can't even buy a single family house unless it's $600,000. How do I make that work? And I tell them to go to Texas. I tell them to go to Louisiana, and I tell them to buy in markets where there are options for property management. You don't want to be in a place that's so small that you buy a nice property. And I know I'm talking about distance now, but I'll get back to buying in your local market in just a moment. You don't want to buy in a market that's so small, even though it's a nice property and everything makes sense, but there's only one property management company in that market. What if something happens to them? You are so toast at that point, right? Because it's in a different market. Yeah. You don't live there. You can't do anything about it. The property management company, the owner sold it. They were accused of fraud. There was a big lawsuit and they had to close down, or they just said, I don't want to be in the business anymore, right? Nothing has to happen other than they said, I'm tired of this. I don't want to do it anymore. You, the property owner that had everything picture perfect, are now in a world of hurt because you have very limited options. So if you're buying in a city or location of size that has competition for property management, then you can consider making an investment in a different market than the one where you reside or one that you can live in, because you can do all that same submarket analysis anywhere, right? You can make the decision to make an acquisition or not. If you want to buy older properties or newer properties, all those things. You may have a brother or a sister in a different market that says, hey, I know you live in San Francisco, but here in Indianapolis, we got some great deals if you wanted to throw some money our way. And you say, you know what, I got $100,000 to do that. So let's make some investments in Indianapolis. Well, great. First question, which submarkets?
Yeah.
Right. So back to the same analysis again, back to rent roll analysis, back to looking at which properties are competing with the one that you're looking at. Again, it could be a single family house. You're still looking at submarkets because people buy in markets that have similar attributes. And if you're buying a single family house in an industrial backwater, you know exactly what you got. You got a single family house that's surrounded by soot and loud trucks and train tracks. Why would you do that to yourself? Mm-hmm. It's not a deal. Doesn't matter if they're giving it to you. It's probably not a deal. So submarket analysis, no market is better than another until you determine that it is as an investor. And how do you determine that? You do your submarket analysis. You look at your yields, right? You look at the opportunity to bring property management to that asset on your behalf. And then you can make a quality decision. And it doesn't matter if it's upstate New York or Orlando, Florida. You need eyes on your property, right? It doesn't have to be your eyes. That's the part that has a lot of people saying, I don't want to do that because I don't want to fly there because, well, now when I have a property manager on site and there's an issue, they FaceTime me and I'm there real time looking at the issue, right? I don't have to, Zoom call's fine. Yes. Microsoft Teams is fine. But hey, if the roof just caved in and I know about it and you want me to know about it more, take pictures. Yes. Call the adjuster. Yes. But at the same time, let's just do a live call and see what's going on. How can I help? I can be there on site if necessary in the same business day.
Got it. Yeah. And that's such a great reminder to not pay attention or not compare your situation to others. I think that's probably one of the biggest downfalls that I've seen of real estate investors is that, they start making some traction and it's like, well, I see Jim on Facebook investing in this market, so I need to be over in that market. They know nothing about that market, nothing about Jim's situation. So it's not apples to apples, So I think having that fresh perspective, like you said, like it's based on your scale, based on where you're located, based on all these different factors, your access to capital. I think that's a really important point.
This was several years ago. There was an investor from southern Missouri that was making significant investments in North Dakota because they were doing fracking up there, right? So rents in North Dakota were higher than what they were in Chicago. It didn't make any sense. But the guys working there were making $2,000 a week, right? So they didn't care about paying $1,500 a month for rents in North Dakota. But when fracking stopped, what happens? I mean, so it's, you have to know more than just the submarket. You have to know the environment. You have to know why these things are happening and not guess. And that may require a trip. Let's say that you live in the Midwest and you vacation in Destin, Florida every year, right? You want to buy a condo in Destin, Florida? Sure, why not? They're only $80,000. But now you've got a mortgage payment, right? Can you rent that? That's my first question. And then you rent a property, any vacation property. Well, can I rent it if I don't want to go there anymore? I loved Destin for a while, but now I like to go to Fort Myers. So what am I going to do with my condo in Destin? So my question is, when I'm buying that type of property in a vacation locale, hey, is it really rentable? I mean, for real, don't fool myself, right? And if it is, what does it rent for? Okay, my payment's $800 a month. It'll rent for $600. That's fine. If I decide not to use it, I'll just rent it and pay the $200 a month in negative cash flow. But I'm going to keep the property. So, because I may decide I want to vacation again in Destin all the time.
Yeah.
So you don't necessarily have to sell it just because you're not using it, but do that analysis on the front end for a vacation home, particularly if it's in a vacation area. Hey, will this thing really rent? Can I rent it? Will the association allow rentals? Or do I have to hand it over to them to rent? And what's my bottom line? What's my negative going to be if I have one, if I end up doing that?
Yeah, great point. Okay, so last question for you. I don't want to keep you all day, but if having the experience you've had and all of the, having written books on multifamily, like you've been a part of over 60,000 deals. If you were to start over again, if you were to go back to young John and, you were just getting into multifamily investing, what would you do today? What are the steps you would take? Where would you start looking? What are the first things that you would recommend?
I would put myself in a buy and hold acquisition mode. I would be looking for scale in a particular submarket until I got to a decent scale there. And then I would geographically diversify to a different market to start to spread my risk and basically do the same thing in a different market. When I got to a third market, I would do the same thing. Again, geographic diversity, making sure I had good quality property management, understanding my submarkets, plural, very, very good. So I know what I have. And then I would look at creating a portfolio that was larger. So if I had 3 homes in Southern California, and I had 4 duplexes in Dallas, and I had a condo in Chicago, I have a portfolio, whether you want to call it that or not. And they're all rentals now, okay? They're all rentals. But all right, that's all well and good. But at some point you have to stop and go back and say, okay, where do I go from here? That doesn't mean your next purchase needs to be in North Carolina, right? You can see if you've been in the market for a while and you've made those purchases in those different markets, you'll understand them very well at that point. And you may decide, you know what, I kind of like what I'm doing. This is fun, but it seems like I've made the most money where I bought the duplexes. So does that mean I want to buy more duplexes in that market, or do I want to buy duplexes in a different market using my cookie cutter strategy that I know that works? Or do I just want to stay and hold? And that's the one thing that people don't take into consideration often enough. Sometimes enough is enough. Most people have on the high side about people of high net worth. They have about 15% of their assets in real estate. So that's a good number. If you're like me at a younger age where 98% of my assets are in real estate, that's not a good thing. Right? There's other things out there, cash equivalents, stocks, bonds, other investments that that are good for a blended, solid investment portfolio, not just real estate because real estate and that's all you ever want to do is real estate. That's can be a recipe for disaster, right?
Yeah.
I had to start over because I put all of my eggs in one basket. Fortunately, I had the capacity to do so. Fortunately, I had a level of expertise where I could go right back into the workforce and make a high level of income. But for a lot of people, if they lost that at 45, they're in a bad place. They're looking at Social Security and they're hoping to get a job that pays them something. That's a bad place to be. So diversification is key, not just in real estate, but as you're a young investor and this is really what you want to do, guess what? All your assets, all your income, all your investment is going to be in real estate for a season. Just recognize that you have to change because seasons change. And at some point, you don't want all of your eggs in that one basket.
Great advice. Yeah, very, very good advice to kind of focus in on one market first, get some scale there before trying to conquer the entire world.
Well, and then people that live in a big state, when I say 3 different markets, it could be 3 different cities in that same state. So if you want to drive to, Dallas is a long way from Houston, but it is a different market, right? Mm-hmm. So I'm not saying you have to invest across the geographic spectrum. You can just, once you know and understand the market, it's great to get a foothold there. But if you're not finding any additional deals, then you need to establish a different beachhead. So where is that going to be? If you're in San Diego, is that going to be Escondido, or are you going to go to Stockton in Central California? So you can find deals.
Makes sense.
So don't let that one market stymie your growth. You just look for other markets that you like, but do the analysis. Know what you're buying. Know the submarket.
It makes a lot of sense. John, what's the best way for people to get a hold of you if they want to reach out or get their hands on your books?
Always on Amazon, of course. Everything is. But on johnwilhoit.com, that is my author website. And I'm building that out now. That's my 2021 pet project. So it's a work in process. By summer, it'll be a lot better than it is now. But we have there's probably about 50,000 words of content there now for people to read.
Wow. And
we've really focused on 3 areas. And that was the hardest part for me, saying, okay, you can't be all things to all people, right? What do people come to you for? And as soon as I stopped to finally ask myself that question, the answer was clear. They come to me for real estate investment decisions. They come to me for property management know-how and for home ownership. So it was my wife that asked me to write 12 Steps to Home Ownership because she said, you're helping all these institutional investors. I want you to help our son. I want you to help our daughter. How would they buy a house? And I said, well, they would call me. And she said, well, yeah, but what about everybody else?
It's not scalable.
So, yeah, is that scalable? No. So that's how I ended up writing 12 Steps to Home Ownership. It's for first-time home buyers. Hey, here's the things you need to do. I try to make it evergreen. Yes, interest rates change, but the steps are pretty much the same. There's certain things you have to do to get into a home the first time. And with the interest rates where they are now, it's a great time if you can do it. Please do. But if you want to be an owner of investment property as a homeowner, buy that duplex or triplex. Become a homeowner, live in one unit. You have to live there at least 2 years per the mortgage rules. And at the same time, you're now a real estate investor because you have rental income. But just bring that property management with you so you can go about your business and do whatever it is you do during the day to make money and not have to dive into learning property management. Learn it over time.
Yeah, great advice. Well, lots of great advice throughout this whole interview, and I encourage people to check out the books, check out the website. The website's great. I know you're improving it, but I looked at it and it's great now. So I appreciate you taking the time today. I know you're on vacation, and
yes,
so
got my vacation shirt on. This is my best T-shirt on this trip.
That's great. No, we really appreciate that. I think the community is really going to benefit from your advice. I appreciate it.
Yeah, well, thanks for having me. I look forward to doing this again.
Yeah, absolutely.